Well, good morning and welcome. Sorry that we're starting a few moments late there, gang. I had a little bit of technical issues. I'd like to, if I could please, have you all text in and let us know that you can hear us okay. And Mike, can you hear me okay?
I can hear you, sir. I might just want to remind you it sounds like you're a little bit lower volume than I'm normally used to hearing, so you might want to make sure you stay close to the microphone for today's presentation. But other than that, sounds good.
Groovy. Okay, and Lily says she can hear me. Steve says sounds fine. Good, Byron. Hello, Byron. I think I wrote an email to Byron this morning. Okay, very good. All right, gang. Well, let's go ahead and get started. My name is Kurt Frankenberg. Just a real quick intro. And I own a martial arts studio. That's been my occupation for more than 25 years now. But along the way, as I was building my studio, I began to become pretty successful with that and looked to put money into the real estate market. And found out that that just wasn't for me. I just didn't like getting calls from upset tenants, you know, when their furnace burnt out or something like that. And decided that I wanted to get into stock market investing. And a fellow who had written a book about real estate investing that I had bought and whose principles I used started doing seminars about stock trading. I went to that and ended up learning some strategies about calendar calls and how to sell covered calls and various option things. And then I I got hurt. What the gentleman failed to understand, he did know how to set up certain types of trades, but he didn't know how to teach me how to manage risk properly, and therefore I got hurt really badly. I went back and got some more education and treated everything exactly opposite as far as the money management part, exactly opposite of what I had been doing, and learned a pretty cool strategy that's now being taught in over 30 countries. So there's my introduction. And Mike, how did we come to meet? And first of all, what is your title? What do you do over at Power Options?
Well, I do a lot, and I have a lot of titles. But for our purposes this afternoon, my name is Mike Chupka. Yeah, my name is Mike Chupka. I'm the Director of Education here at Power Options. And Power Options has been in business for about 14 years. It was created by Ernie Zerenner after he retired from Hewlett-Packard. And our tools are a patented suite of search and analysis tools designed for self-directed options investors. We support over 23 different strategies. And I've had the great pleasure of working with Ernie and the Power Options staff for the past 8 years. Now, what I do is I teach the various option strategies to our clients and subscribers, write books and articles on options investing and the different strategies. I am an investor myself, of course. And I got started as many of you might have gotten started. I started off, I learned covered calls from Ernie and some naked put trading as well, which is a parity trade. And then I expanded into standard collars and calendar spreads. And about 3 years ago, one of our customers had called in and needed some help with the historical suite of tools, the back testing tools, to get better acquainted with identifying positions. And, of course, the customer was Kurt. And as I was walking him through how to use the historical suite of tools, I said to him honestly what he's going to address today, looking at that position that, excuse me, what I was doing there is I didn't understand how he was going to make money with these positions. And of course, in the email that Kurt sent out today, he said that he was going to take a look at that and he's going to explain exactly how he makes money with these positions. Well, long story short, I was so impressed with the techniques once I figured out how he was going to be able to implement these trades that I invited Ernie Zerenner to join me for the next 2 presentations, and Ernie was so impressed with it that we partnered up with Kurt and, of course, enhanced some of the tools on Power Options to work specifically with the radioactive techniques and the portfolio tools as well.
Very good. Okay. Mike, that was a big concern, was that you looked at my setup and you said, how on earth can you make money with this? I don't think you can. And, of course, afterwards, now you have been doing radioactive trading methods for a number of years now, right? About 2 or 3 years?
Mm-hmm. That's right, Kurt.
Very good. Okay. Mike, I'm going to go ahead and launch into the presentation. I'm going to make a bold promise, okay, and we're going to back this up. I'm going to show you 2 riskless spread trades that can capture much more premium and growth than a covered call. Okay, and I'm willing to bet that you're going to take a look back over your trading for last year and wish that you had had this knowledge sooner. Okay, but we're going to give this away. And these 2 plays are only 2 out of the 10 income method adjustments described in the blueprint. I'm going to show the money net, income method number 5, and the bulletproof vest, income method number 3. These are nicknames that I have for these spread trades that have no risk. Now, here's a promise. One of those methods, the money net, can potentially improve your returns better than if you sell a covered call. Okay, if you're an income trader, you like to short calls against stock and so forth, I think you're going to really dig this. All right, but the other technique is a way for leaving your upside open, and therefore there's no short call involved, but it's still done at a credit. You still get to collect income for doing it, and you take in a credit and you reduce your risk in a trade and do it at the same time. It's kind of cool. So they say that if you give a man a fish, you feed him for a day, but if you teach a man to fish, you feed him for a lifetime. So here's my challenge to you. At the end of the program, I'm going to point out the difference that knowing these 2 techniques that we're giving away for free means in dollars and cents. And, of course, you can use this for the rest of your life, all right? And if you feel as though I've given you something valuable, here's all I'm going to ask in return. I'm going to ask that you consider investing in yourself. Consider picking up a copy of the blueprint, or if you already have the blueprint, maybe engaging in some ongoing coaching. Okay? So is that fair enough? You're not making a commitment here right now. You're just saying, hey, I think that's fair, or no, I don't think that's fair. Go ahead and text in your answer there, folks. I'm going to wait for 2 or 3 of you to do so, and we'll just jump right on. In the meantime, I would like to send out a poll and find out what kind of options trading you're doing right now. Steve says, sounds fair. Good for you, Steve. I appreciate it. Jeff says, cool.
Did you answer Jeff's other question?
Jeff had, oh, yes, actually, you know what? I think maybe he's saying cool to my answer.
I think that's what it was. Yes, sir. Yes, sir.
Very good. Cool. Jeff had mentioned, geez, you know, I don't know if I have enough capital to do this with stock. Could I do it with simply straight options plays? And I answered him that the principles the techniques can be applied, yes, but the principles of keeping your risk down to single digits, probably not. And you've done a white paper on that, Mike, and I referred to that.
I'm actually doing another one.
Oh, go ahead.
I just mentioned this to Ernie yesterday. I started writing another white paper. It's a little bit longer, and it's actually going to be addressing all the different ideas that I had when I first started with radioactive trading, because I thought I was smarter than Kurt. And we get a lot of questions that come in. So we get a lot of questions of, aren't long calls better? What about if I bought an in-the-money long call and the put as well? Isn't that better? What if I did the synthetic trade by shorting a put, buying a call, and buying the put as well? Isn't that better? And we've looked at all of them, and I experienced the same thing when I first started. So I'm going to write a white paper that compares all the positions and explains why we don't advocate doing those other alternative methods against the married put position.
That's right. The initial RPM setup is less about options and more about probability, statistics, and money management. Mm-hmm. It's really more about keeping your risk down into single digits. And while you can do similar types of things with pure option strategies, it's not the same. It's not the same. It's similar, but it's not the same. And so, very good. I did mention an encouraging word, though, to Jeff, and that was that I started with only $25 in capital and was still able to use the principles, you know, buying stock and buying and put option. Mike, we've got 64% of our audience here doing covered calls, mm-hmm. Or naked puts, which is the same risk profile. We got 36 doing long calls and puts. We got 64% doing spread trades. I think that's going to be exciting for the spread traders because we're going to show some riskless spreads, and we're also going to see something that's superior to covered calls. So, Mike, you've heard this little chestnut, right? Cut your losers short, let your winners run.
Absolutely, Kurt. It's a common mantra that exists across the market and other investment strategies, and it sounds a lot also like buy low, sell high, doesn't it?
Yeah, it's like, hey, thanks for that. Could you give me some practical instruction? You know, how do I make sure I buy low, sell high?
Right.
How do I make sure to cut my losers short and let your
Oh, Kurt, I think your sound just cut out, so I'll pick up where you left off. The idea is, yeah, it sounds simple enough, but how can we actually implement that? What is the techniques to implement that into our personal portfolios? And what the radioactive trading technique solved is a setup that forces us into this particular position, that forces us into a position where we start off where we can have our losers short.
Okay, it said audio. Sorry, Mike, it said audio connection loss, and now it says restored. So am I back? Can you hear me?
You are back. I was covering for you as you disappeared, and I was just explaining this a little bit more, and I think we've got it covered.
You're so cool. What a professional. All right, gang. Sorry about our technical issues today, but I think you'll be really pleased if you stay with us and you know, bear with us. So, what if you could guarantee that you'd always do this? Well, I can guarantee that there's a way to do the reverse, and that is the covered call setup. Mike, does this really seem to gel with the idea of cutting your losers short and letting your winners run?
Well, it looks opposite, doesn't it, Kurt? I see a position here where if the stock moves up as I'm expecting, I'm going to cut my winners short, but I've opened up the bottom to allow my losers to run.
Yeah. And just to let you know, this isn't my propaganda, okay? I took this off of the Options Express free education site. Gosh, there's similar things just like this all over the place. Colorado. I'm sorry, the Chicago, not Colorado. I'm in Colorado. But the Chicago Board of Education, Options Education, all these different things, they have these graphics that show that covered call trading, the covered call is bullish. And it is because most of what you are doing there is buying stock, right? You're mixing it with a short call, but it's not really so much neutral as it is bullish. Otherwise, you wouldn't buy the stock. I don't think I gel with this, that it's safer. I don't think I really buy that, because if you're going to get a handsome return with your premium, you're going to have to invest in a more volatile stock. And when it's more volatile, which is the only time that the covered call strategy really makes sense anyway. If it's more volatile, then it's also could go down, you know, just as much as it could go up. It's very risky. Okay, so I wouldn't say that it's safer, but I will go along with this where it says that the reward is limited. So that's kind of the opposite, isn't it, Mike? We've got cut your winners short, right? If you're right about the stock, you were bullish to begin with, you're right about the stock, and then you agree to less than perhaps what it could do. On the other hand, you're allowing your losers to run, so that's kind of backwards. What about this one? What about spread trades? A bear call spread, for example, receives a credit on the front end. And of course, if we did a bull put spread, that would also receive a credit on the front end, and just this portion would be reversed. It would be a bullish spread. But
True.
It would be safer. Would you go along with that, Mike? It's kind of a safer type of a spread?
It's safer in the sense that we know our risks going in, that there is a defined monetary risk, as you can see on this position in the worst case scenario. In this case of the bear call spread, if it goes above the higher strike call that you purchased, you would receive the maximum loss. So you know what that is up front. But I do have a problem with saying the strategy or the portfolio as a whole of just doing vertical spreads is necessarily safer.
Right, yeah. I wouldn't say that it's safer without also introducing the elements of money management. You know, for example, if you took all of your capital and put it into a bear call spread, you could be asking for trouble. If you put, you know, 2% of your capital into a bear call spread and it went against you, well, you know, it wouldn't hurt you too badly. You'd still be able to live another day, right?
That's true.
Yeah, so if this is coupled with proper money management, then I would say I would go along with the fact that it's safer, because it does cut your losses, right? All right, but does it also cut your rewards? Does it allow your winners to run?
No, and in this case with the bear call spread, we have a capped gain if the stock falls or declines as we expecting or stays below the short call strike price. And normally when you set up a spread such as this, and the other part that Kurt and I were referring to about how this can add risk, is that if I'm looking for a higher probability of success on a bear call spread, I'm going further out of the money. So I might only be collecting a net credit of 20 cents, 30 cents, 50 cents because I'm so far out of the money, but still risking 5. So one trade goes against you, it could wipe out 10 previous gains.
Right, yeah. If you're right most of the time, you actually could still lose overall. You can be right more often than wrong and still lose. On the other hand, with radioactive trading techniques, you can actually be wrong more often than right and still make money. So that's kind of cool. Here's the deal, Mike. About 10 years ago, I got this weird idea that maybe instead of setting up a trade in such a way that the losers would stay in my account and the winners would get sorted out, I would reverse that situation. Okay, and so stocks that I was bullish on, I would go ahead and buy the stock, but then I'd also buy a put option to protect myself. And as you'll see in a few moments, it's a little different than traditional. Okay, but would you go along that that is a safer way to go, particularly if this gap here is represented by about 3 to 5% of risk rather than 20, 50%?
Absolutely. We're kind of skewing the results in our favor, aren't we? One of the things that the married put setup, this radioactive trading setup, I should say, takes advantage of is we're skewing what's known as the martingale or gambler's ruin in our favor. And if you suffer a 25% loss on a position, you need a 33% gain to get back to break even. And if you suffer a 33% loss on a position, you're going to need a 50% gain to get back to break even. But if you skew that in your favor, so we are not risking more than 5, 6, or maybe even 7% on a given position, well, if you have a 5% loss, you don't need a 10% gain to get back to break even. You only need about a 5.3% gain.
That's right, yeah. A 50% loss, you'd have to double your money on the next play, which would be a 100% gain, right? But a 5% loss, you wouldn't need 10. You'd need 5.26. And so that's really the foundation of the first radioactive trading principle. The first radioactive trading principle is called FIST, force ideal size trades. We want to force ourselves not to take too big of a risk percent-wise on the front end. Now, as the trade develops, we can actually make it so that, we could even margin and leverage our way out of it. After making ourselves bulletproof, we could actually take all of our capital off the table and still have unlimited upside, still have a position in plus. That's kind of cool. All right, that's a little bit beyond the scope of what we're going to share today, but savvy margin traders are going to see that a little bit later on when you see that we're bulletproof. Okay. Now, Mike, what's really cool is I will go along with this safer aspect, but the reward, the potential reward, you understand, is unlimited. So does this fit that saying, cut your losers short, let your winners run?
Yep, as we talked about a little bit before, we're forced into a position that has that happening. We're forced to cut our losers short and let our winners run.
Very good. Okay. I'm going to take a second right here, and we're going to solve the biggest problem that most folks have in their trading. Okay? And then we're going to see the practical way to achieve it. And I'm going to do a baseline just before. I'm going to do a baseline reading here. Looking back the past 12 months, how happy are you with your trading? This is our baseline reading, right? Are you happy with your trading results? And the answer ranges from, yes, I made piles of money in 2010. I'm doing good this year so far. Or, hey, I'm happy, but I could stand to be happier. Or, geez, mixed emotions. I've won some, but sure, I've also lost some too. So, I can't properly say I'm happy with my trading results. But mixed emotions. Or unhappy. You'd rather take a physical beating than a financial one. I put that in there because my radio producer said that. He said, Kurt, I'd rather take a physical beating than a financial beating. I thought that was kind of cute. Or, the last category there is my results sucked. I'm ready to throw in the towel. Okay, and so we got 3 more minutes. I'm sorry, 3 more seconds. I'm not going to leave that poll up there for 3 more minutes, Mike. Okay, let's go ahead and close and share the results. Okay, so far nobody We don't have anybody on the far extremes, okay? We don't have anybody saying, wow, I made piles of money, I'm so excited. We do have 62%, that's actually very high, saying I'm happy. Of course, I could stand to be happier, but they're saying, hey, I'm happy. And then 38% saying mixed emotions. This is actually probably the most optimistic crowd we've had this year. Would you say that, Mike?
Not only in 2011, but I'd say in the past 12 months total, from May of last year, or I should say June of last year to June of this year.
Yeah, the last, I would say that this is the most optimistic crowd, or the most happy crowd. So that's actually very good. We're going to, with this baseline, we're going to see if we can make you even happier. I think we probably could. Let me go ahead and hide that poll. And I'm going to say that everybody could do better, right? For example, nobody answered in the first category saying, I'm so happy I can barely stand. Okay, it was either I'm happy, could stand to be happier, or it was mixed emotions. Okay, so let me go ahead and ask, what one thing, and read through all 5 of these, consider it carefully. What one thing, if I could wave a magic wand and grant you the solution to this problem, what would you like it to be? Would you like it me to give you more time? Would you know that you could only pick winners? Would you like to make your timing just precognitive? Would you like to just be able to tell the future? Would you like to, just manage your losses to where when you do have a losing trade, it doesn't hurt you too badly? Or would you like to have your winners win more? And let's give that a few more seconds. And I know that everybody's taking their time and considering this very closely. And you should, figure this out real closely, okay? Let's give it another 3 seconds, 2 seconds, 1 second, and there you go. Okay. It's a clear thing that 3 out of 4 of our audience thinks they do.
Well, okay, looks like Kurt cut out again, ladies and gentlemen. I apologize for that.
Okay.
There we go.
Am I here? Okay. I asked you a question, Mike, and obviously it didn't come through. I said, what is the clear result that 3 out of 4 of our audience members want to do?
Well, we figure that the biggest problem we're facing with our trades is that we can allow ourselves to lose some, but we want to limit our losses a little bit more, or a lot more in some cases.
Right, okay. And second place is picking winners more often. Mike, I actually pick winners about 47% of the time. That's less than half. But as you've seen by looking over my shoulder and in your own trading results, you found that picking winners is not necessarily where the money is. It's more about allowing your winners to run. If I pick winners 47% of the time, that means more than half of the time I'm losing, right?
That's right. Yeah, you've got a losing track record.
Yeah, I have a losing track record if you just look at the percent of times that I'm right. But if you look at how right I am versus how wrong I am, that's a different story, isn't it? I mean, let's put it another way. If you look at how much I lose versus how much I make on the winning trades, well, the winners clearly outpace the losers, okay? So I'm going to say that that's probably a better way to go. 9% said I need for my winners to win more, and guess what? We are going to show that. We are going to show how to leave the upside open. But we're going to certainly solve the problem here for at least 3 out of 4 of our audience, okay? So let me go ahead and share that structure right now, okay? The structure of a radioactive profit machine. Here we are with shares of Altera at $27.35, and this was September 14th, okay? At the same time, I bought the March 2011 $29 put options at $3.50, okay? So that is a total invested amount of $30.85. Now from there, I have a guaranteed exit of $29. How come it's guaranteed?
Well, the put that you purchased gives you the right to sell your shares of stock, to force someone to buy your shares of stock at $29. So no matter what happens to the stock, even if it drops to 5 cents per share, you'll be able to close it or force someone to buy your shares at $29.
Right. So the amount that I have at risk is really the difference between the total invested and my guaranteed exit, or $1.85. And when you set that $1.85 against the total invested, that's 6%. Now, Altera is a pretty volatile issue. Can you imagine setting a trailing stop loss of 6% and leaving it in place for 6 months with a stock like Altera?
No, I could imagine getting stopped out of that position within the first week, or the first 7 days, or maybe 10 days, because the stock's going to fluctuate in price, isn't it?
Right. Okay. So this is actually better than a stop order, because what I'm doing here is I'm guaranteeing myself 6%. If Altera suddenly fell out of bed, if there's a bad earnings announcement, or the CEO died, or something ridiculously bad happened, and the stock opens at $10 a share, if I had a 6% stop loss in place, would that 6% stop loss protect me at the 6% level?
The 6% stop loss would, no, if you just had a stop loss, it could get violated.
Well, help me understand that. What's that mean? If the stock opens at $15, for example, wouldn't I just get out with a 6% loss?
Well, no,
stop loss order?
Because with stop loss is more of a market order that says get me out at the worst possible price. And so what ends up happening is that if the stock gapped down to $15 per share, my order is triggered, but I don't get filled at the 6% loss. I get closed at $15, and now essentially I'd have close to a 50% loss.
Wow. Okay. All right. So, so having that put in place is kind of a good thing. It's an insurance policy. But Mike, when you looked at this number, what did you say to me?
Well, I said that there is no way, that I don't see how you're going to make a profit on this. And yeah, I understand that you've limited your risk to 6%. That's great. But now you need the stock to move up to $30.85, really $30.86, before you make a penny on this position.
Right. And that's what a lot of folks say. By the way, you didn't actually say that to me about Altera. You said that to me about another stock like 3 years ago.
That's right.
But since then, you've employed the radioactive profit machine to make money on a lot of trades. Here's the deal. When you set up the radioactive profit machine, all right, which is simply an in-the-money, far-out-in-time put option coupled with ownership of stock, all right, when you set that up in the first place, if your stock goes up, yeah, you can make money. But if the stock goes down, you can't get hurt too badly. Now, this break-even line here, this is what we're just talking about, the $30.85. Let's go back one. All right. That's where the break-even line supposedly is. Okay. But I'm going to say something, Mike. For me to lose that $1.85, you know, the difference between what I've spent and what I'm guaranteed to get back, for me to lose all of it, 3 things have to happen. Number one, the stock has to go down. Now, do I have any control over that?
Well, you don't have control if the stock's going to move up or down. You researched it and analyzed it, and you expected it to move up in price, but you don't control the movement of the stock, sir.
That's right. I can't guarantee that I've picked a winner, and I can't guarantee that I've picked it with good timing. All right? But what I can do is do something about these other 2 factors. The other 2 factors are, man, in order for me to lose that whole 6%, I've got to hold that stock all the way until expiration. It's September, and I've got to hold it all the way till March. Now, do I have to do that? I don't have to do that if I don't want to.
No, you absolutely not. You have the choice.
Yeah. Okay, and another thing, too, is I can do adjustments, and there are several adjustments that we teach in the blueprint. 10, in fact, ways to change the risk-reward structure of this way before the expiration. Okay, so that's where we're beginning. Okay, so now the income methods are going to reduce the gap. Whatever this line happens to be, 30.85. Okay, if it is $30.85 total expenditure for the stock and for the put, most folks believe that I'm not going to make any money until the stock is at 30.86.
Right.
But the income methods reduce the gap. The income methods make it so that that number changes. Okay, and here's what happened with Altera. All right, with Altera, I got in at this point, and I missed an opportunity. See here where it peaked for a moment and then fell down. I missed an opportunity there, but as it began coming back up, I used income method number 5 instead of income method number 1 or 6. I used number 5 right here as it was recovering. Now, what's got to happen? Part of what I did there, Mike, part of what I did was to sell calls.
Mm-hmm.
And so what's got to happen the minute I sell calls?
Well, if you're selling calls, Kurt, the stock's going to go up. You're going to have a nice little movement upwards there.
Yeah, no fun. All right. And it got up to this point here, past the $29 short calls that I had sold. But what actually happened is over here on expiration Friday, the stock did close above $29, but I got paid to hang on to it. I know it sounds a little weird, okay, but I got paid to hang on to it. And, of course, the stock went on further than that later on. Okay, let's take a look at how this works. All right, I've got the Altera shares. I've got the put option that I spent $3.50 for. The total invest is $30.85, and the guaranteed exit is $29. So the amount at risk is $1.85 or 6%. Now, on September 24th, the stock was trading at $28.50. If I had done a covered call, now I'm not saying that I had done this, but if I had done a covered call, here's what would have happened. I would have been able to sell the October $29 call for 85 cents. Now, Mike, I've spent $30.85, right?
Correct.
85 cents credit is going to reduce the cost basis down to 30, right?
Agreed.
Okay. And I still have my guaranteed exit in place at $29. So in case the stock goes down, my risk is $1. Okay? If the stock went up, I'd still have a $29 put option, but it'd be way out in time. Do you think it'd be possible that I would be able to sell that put option for the 85 cents or better, seeing as how I spent $3.54?
Yeah, it would still have time value on it. Of course, you would run into the problem where you still have $30 invested and you've got a 29 call on the position. So the price where you might get assigned is actually below your cost basis still. So the put would still have to retain at least $1 value for that to be worth anything.
Yeah, actually 85 cents value. Because here's the deal. I've collected $1, and I'm going to sell it at 29, so that'll be 30 of my 30.85 back. That makes sense. So my put option should be worth 85 cents or more for me to stay out of trouble. Well, the point is here I've reduced the risk, right? But this isn't what I did. I didn't actually do it. I didn't actually sell a call. On the last page, the cost basis was $30. And if the stock was above 29, which it was, I'd have to pay to prevent assignment, right?
Yes, you have to cancel the calls to avoid your obligation on the stock.
Right. Now, on October 15th, with the stock at $29.40, it closed higher than that. But while it was at $29.40, those $29 calls were selling at 55 cents. So if I bought them back, right, my cost basis for the stock and the put would be $30.55. And I've still got my guaranteed exit of $29. So I have a new at-risk amount of $1.55 instead of $1.85. So that's one way to do it. It's called income method number 1. And I share that because a lot of folks have got some understanding with covered calls. But now I'm going to show something better. Okay? Something better. Here's how it went. I said that there were short calls at the $29 strike, but also that I got paid to hang on to the stock and afterwards to leave the upside open. Kind of cool. Okay? So introducing income method number 5. Here's what happened. Rather than selling calls, just plain vanilla doing a covered call, okay, what I did was buy one call at a lower strike and sell 2 at a higher strike. Remember I said that the stock had been trading at $28.50?
Right.
Well, that meant that the $29 calls were out of the money, and so there's a lot of time value there. It's out of the money, but just barely, just by 50 cents. And the $28 calls are in the money, which makes them, a little more expensive. So what I did was sell 2 29s for each 28 that I bought. So does that generate a debit or a credit?
Well, in this ratio spread, you're going to generate a credit. You collected $1.70 for selling the 229 calls. You paid $1.45 for buying the 28s.
That's right. Now, interesting deal here, Mike. If I get a net credit of 25 cents, if I just did this spread, right, and I didn't own the stock, if I just did the spread, this spread would represent infinite risk, wouldn't it?
By itself, yes, because if you just sell 2 calls and buy one of those short calls is naked. It's not covered by the long call or anything else. So if the stock shot up to $40, $50, $60 per share, you have infinite risk on one of those short October 29 calls.
Okay. But if I already own the stock, then what?
Well, then essentially what you've done here is created a covered call position with a bull call debit spread that you received at a credit.
Okay, a bull call debit spread. A bull call spread that I've received at a credit? Okay. I guess the way that works out is because one of these short calls is written against the stock, right?
That's right.
And so that generates me some income. And then the other short call is written against this $28 call, so there's a bull call spread. Yeah, and so it ends up being a bull call spread that I get at a credit plus a covered call. Interesting. Okay, so here's the deal, all right? Let's actually think about this for a minute. If the stock stays flat, all right, I said it was at $28.50. If the stock stays flat, what happens to these $29 calls at expiration?
Well, they would be worthless. They're out of the money, so they expire worthless. You don't have any obligation to deliver your shares of stock.
Okay, but what about these $28 calls?
Well, if the stock was still at $28.50, those 28 calls would be 50 cents in the money, so likely you could sell to close that call for about 50 cents or use it to purchase shares of stock at 28 if that was your goal.
How about that? Okay, so I could turn them in for 50 cents, maybe 55 cents before the end of the day. And so what I will have done then is catch some credit. You see, I've got a 25 cent credit here, and then if these guys expire and that's worth something, then I'll catch a little more. So kind of cool. Now, what actually happens is the stock went up above $20. Okay, and so I'm going to show you what happens with that. Oh, if it closes below 28, what happens? I still keep the 25 cents, right?
Yeah, everything expires worthless. There's no value in the 28s or the 29s, and you keep that 25 cents.
That's right. Okay, so I've received the credit for sitting on the stock, and here's the deal: the total amount invested in my married put, okay, my radioactive profit machine had been $30.85. Now I'm subtracting 25 cents, so now my new cost basis is $30.60. Okay, still have a guaranteed exit of $29, and so my remaining at-risk amount is $1.60. That's the worst thing that could happen is I could lose $1.60 if the stock crashes. Okay, now, Mike, before we go on, I'd like to do something with our baseline reading. Do you remember when we did this, looking back over the last 12 months? How happy are you with your trading? Okay, this was our baseline. Now, before I show how this income method panned out, I'm going to say if you kept your last year, but all of your losses were cut down to 6% or less, and what I've just shown is how to take your 6% and make it less, right, by taking a small bit. Okay, 6% or less, would that have changed your answer? Okay, if you kept your wins from last year, if you'd have kept your wins from last year, but your losses were cut down to 6% or less per trade, or 1% risk of your total portfolio, would that have changed your picture? And we're having some pretty good response here. I'm going to leave that pull up for another 10 seconds. And Mike, we're going to have some real interesting time here looking at income method number 5. Okay, let me go ahead and close that poll and share the results. Okay, it appears to add up to 101%, but that's because of rounding. 67% would have said, yes, I'm very happy with my trading. How many had said that before? 0?
Yeah, no one said that they made piles of money, that they were extremely happy.
Right. Nobody was in that first. Now, we did have folks say happy but could stand to be happier, right? But we didn't have anybody say, yes, I'm very happy. Now we've got 2/3 of the audience saying, yes, I'm very happy. Okay, now 17% had said no or mixed emotions, but would have been happy. Okay, and then 17% would have lost, but lost much less. So looking at this chart here, could 100% of our audience do better with just the setup?
It looks like it, because 67% would have been extremely happy, and the other 17% would have been happier for mixed emotions, and then 17% admit they might have still lost, but they would have lost much less.
Right. Okay. Now, Mike, I'm going to go ahead back to our example, and we're going to show the end of income method number 5. Okay. And after that, we're going to have a brief commercial, and then I'm going to show income method number 3, the bulletproof vest. Okay. So October 15th, here it is. Okay. Remember, I have bought stock, I've bought a put option, and against it, I've sold a ratio call spread where I bought one call and sold 2. Okay. So here's the deal. On October 15th, remember the last page, my cost basis for the stock and the put has been reduced to 30.60, not 30.85.
Mm-hmm.
Okay. Now, because the stock is trading at $29.40, it's likely that it's going to close above $29 and my stock's going to be assigned, and I don't want that to happen. So what I do here, Mike, is I buy to close one of those $29 calls at 55 cents. Well, that adds to my cost basis, right?
Mm-hmm.
Okay, so my cost basis is now $31.15, all right, and I've still got my guaranteed exit of $29, all right, so now the at-risk amount that I have is $2.15. Now, is that better or worse than the $1.85 that I had at risk before?
Well, it's worse, Kurt. You've added 30 cents to your total risk. This looks like it's going in the wrong direction.
Okay, but we can't forget this, okay? Remember, I had bought a long call and sold 2 short, okay? If I had done income method number 1, just the covered call, I would have taken an 85-cent credit and then spent 55 cents to keep the stock, and so I'd keep 30 cents. But by doing the money net, it looks like I lost 30 cents because I collected only 25 cents on the front end and managed it by buying to close at 55. Okay, that looks like a 30-cent loss, but we can't forget this. Okay, let's not forget that I had bought one $28 call and sold 2 $29s. Now, by buying to close one of those calls, what that leaves is, it leaves a bull call spread. It leaves one long $28 call that I own and one short $29 call. And how much have I spent so far?
Well, it's the 30 cents, right? The difference between buying that one call back for 55 cents and the original 25-cent credit you received for the position. Okay,
now I hope nobody's head is spinning, okay, because this is, if this is your first time through this, it might be a little confusing, but you know, we are going to have a recording of this, and also the new sketch has all these numbers and this whole sequence. The new free publication at Right After Trading has got all this stuff, so that you can go over line by line and work it out. What I've done, Mike, is I've gotten myself a bull call spread, and I financed the purchase with a covered call. I've closed the covered call trade, but this bull call spread now is going to win. It's going to do its highest payout because the stock is at $29.40. Okay, it closed that day at a little higher than $29.40. In the middle of the night, the broker looks and says, "Hey, Kurt's got the right to buy stock at $28," and he does. And then he says, "Hey, Kurt's got the obligation to deliver that stock at $29," and he does. And so, in the middle of the night, without me having to do anything, I make $1. So I've paid 30 cents out, and I get a 70-cent credit. Pretty cool?
Very cool.
All right. Now, if I had just done the covered call where I sold it for 85 cents and bought it back for 55, that would have been a 30-cent credit. But instead, in the same time frame, I collected a 70-cent credit, 133% more by using the money. Kind of cool. Okay, so here's the situation, Mike. After closing the short call, all right, my adjusted cost basis had been $30.60 for the stock and the put. I buy to close one of those $29 calls, since that raises the cost basis. But then, in the middle of the night, my spread closes in the money, and so I make $1. And so now my new cost basis is $30.15. I've still got that put in place, right?
Right.
So that's going to keep me out of trouble. So what I've done here is I've reduced the gap. Remember when folks said, "Man, Kurt, you can't make any money until it goes to I'm sorry, what was it, $30.85?
It's $30.85. Yeah. That's right, sir.
Right. folks said, okay, Kurt, you spent $3.50 for that put option. You can't make any money until your stock goes higher than what you spent.
Mm-hmm.
That's not so. That's not true. I've just reduced the gap. Okay? All right. Now, before I show the income method number 3, I'm going to run another poll. All right? And we're going to also do our offer for the blueprint. So first of all, I'm going to do this poll here, and then we're going to show the vote at the end. Could you put a dollar amount on how much better you would have done last year if you had done what we said as far as saving, 6%, getting out of your trade 6% less, 6% loss or less, okay, by keeping your wins? Can you put a number to that? Now, some folks are going to maybe say, geez, I can't see how that would help at all, forcing myself not to risk too much. Some folks will say, well, geez, I would have saved at least $350 on one of my bad trades from last year.
Mm-hmm.
Or some folks would say, that makes a $1,000 to $5,000 difference, or a $5,000 to $10,000 difference, or more than $10,000 difference. Let's go ahead and take a look at that. Give it another 5 seconds. Nobody's mentioned the first category yet. Okay, we'll go ahead and close it. Give everyone a chance. Okay, all right, so nobody said, I don't get it. Why would I want to force myself not to lose too much? So everybody agrees that that's a good idea. 13% would have saved at least $350. 38% would be ahead by $1,000 to $5,000. 25%, $5,000, $10,000, and another 25%. This information would have made $10,000 worth of difference.
Mm-hmm.
That's awesome. That's awesome. Very good. I'm going to ask, what do you want to know next? and I'm going to throw up that offer for the blueprint as one of our things if enough folks want it. And Mike, we still need to go through the bulletproof vest. I think we're going to do it in pretty good time. Have any questions come through that you think would serve the whole group?
Well, Arjun had some questions that came in, but the questions that I answered there are where you're going next. Now, originally he asked, why are you showing a spread that's, why are you showing a trade that's 9 months old? I mean, anyone can show a profitable trade in hindsight. And, I informed him that we like to show, you prefer to show this trade during the presentation of the Altera because it's actually closed. We went from beginning to end with this position, and that's why you like to share it. And right now you have several trades open in the Fission account for the Fission subscribers, and half of those trades, I believe, or more than half of those trades are bulletproof, and we'll share those occasionally when you do another adjustment. But you've got probably half of your positions that you're tracking in Fission right now that are bulletproof, that have no risk. And then his follow-up of questions, of course, were how much is Fission and how much is the blueprint, so we're getting right to that next step right now.
Very good. Yeah, it doesn't make any sense for me to show current trades because that kind of would be a snub to my Fission subscribers. It's not fair to them. They're paying to look over my shoulder and look at current trades that I'm in. And believe it or not, this trade that I'm showing is not one of the more successful ones. It only made 12%. It's not one of the more successful trades, but it's a good one to share. Because it's got lots of good examples for spread traders and for covered callers to be instructed by. Okay, all right. So we got a lot of folks want to see that offer for the blueprint. So and second place is how do I find these kinds of trades? And I'm going to answer that one first. How do I find some kind of trade? I find these kinds of trades. The thing that I'm using now is Power Options, okay? And Power Options is beginning to power a search tool on radioactive trading itself. But let me go ahead and send everyone this link, poweropt.com/RAT. If you want to find out how to find these kinds of trades and have all the math done for you as far as what your risk would be, if you bought a far out in time put option that's slightly in the money and use all the same search parameters that I'm using, you can go to powerout.com/RAT and get the free use of that tool for 2 weeks. If you decide afterwards that you want to buy it, then not before, but then is when you would supply your credit card information, and your billing wouldn't happen for another 2 weeks, so you get a free month. Okay, so powerup.com/RAT. This is Mike's big deal. And,
well, it's not mine. I didn't create it, but it's.
You didn't create it. Yeah, Ernie created it, but I don't think anybody knows how to do this better than you.
Well, that's my job.
So that's your job. Good. Okay, gang. We're going to do that offer for the blueprint, and then we're going to come back and show the bulletproof vest, which I think a lot of folks really are going to be blown away by. Here's a review of the offers, okay? In any offer, what you get, what it will cost, and what you risk. Really important to have all three of those. Go to radioactivetrading.com, and that's where you could pick up the blueprint. Now, I think I may have gotten the wrong presentation. Okay, that's a presentation that talks about, yeah. Okay, that's a presentation that talks about the, what do you call it?
The CDs there. The CDs are also offered.
The CDs.
Mm-hmm.
Right. But I'm trying to get to, I'm trying to get to
Excuse
this.
me.
Let me go ahead and press it, and I'll show you. Bless you.
Excuse me.
All right. We're going to go to products page on radioactivetrading.com. Very good. And the blueprint is $339 plus $11 shipping. Okay, so that's that $350 that I was talking about earlier when I said, hey, how much better would you have done dollar-wise, and 13% said I would have saved at least $350. Well, we gave you for free. We gave you the strategy of how to set up a married put. Okay, I'm going to say that getting the sketch and particularly getting the blueprint will help you fine-tune that process. All right, and then using that powerup.com/RAT will help you search for current trades. All right, I'm going to say that, but that we've given you away. As far as the other, the 10 income methods, that's all inside the blueprint, and there's several bonuses. Okay, bonus number 1, if you do decide to take advantage of Fission, it's normally $69, but it's $10 for your first month. All right. You get a Foundations of Radioactive Trading CD, which will teach you how to apply the radioactive trading methods against a large portfolio, right? And bonus number 3, you get a free month of Power Options. All right, that link that I shared with you, that will give you an overview, but this will be real-time quotes and a month free if you pick up your blueprint today. And of course, the guarantee. What you risk is nothing, because Mike, if I was to invest $350 in this book, right, and the book turned out to have no value to me at all, how much have I lost?
Well, if you go with this this offer here and you take advantage of the free materials, but if you decide it's not for you, well, you're risking, $339. Let's call it $350 if you incorporate the $11 shipping fee. Okay.
All right. So that's my risk, and of course, I'm betting that I'm going to have more of a reward. On the other hand, what if the company was to take out all the risk? If there's a 100% satisfaction guarantee, why then we've got a bulletproof trade, right?
That's right.
Okay, so folks, I'm going to say before the end of the webinar, you're going to want to log on there and take advantage of all 3 bonuses, okay? All right, let me go ahead and get back now to the presentation, okay? We're going to rewind. We're going to look at what happened after income method number 5, okay? So, at income method number 5, here we are, the bulletproof vest. Okay, remember the income methods reduce the gap. We started out with 6% risk here, and then I received 70 cents credit, which took out nearly half that risk, okay, a little more than a third of the risk. And then now, on the same day, Mike, I decided that I wanted to hold the stock through an earnings announcement. Now, sometimes that's a little, a bit of a nail-biting time. And I could have just gotten out right here, right? Because the stock is up, plus I've been paid 70 cents to sit on it, and the put hasn't lost very much value. You see, the put has lost 98 cents of value. Remember, I paid $3.50 for it.
Yes.
$2.50. And the stock has gone up by more than $2. plus I've been paid 70 cents to sit on it, okay, but the put has only come down 98 cents. Well, I could have closed right here and now for a good solid profit, but decided I'd rather sit through an earnings announcement. And that earnings announcement happens November 4th. Now, Mike, what I did here, and I don't do this often, okay? I don't very often put on the bulletproof vest. I'll do other means to bulletproof. But sometimes if it's an expected event and I just want to be bulletproof before that expected event and I want to close it shortly after, I'll do this. I sold the March $29 put option for $252.
Okay.
And at the same time, bought the November $30 put option for $1.62. Now, is that a credit or a debit?
Well, you're going to receive a credit for doing this, Kurt. You're taking in $252 off of your cost basis, which did include the original price of the puts. You're removing $252 out of that, and then you're paying $162 back. So you're lowering your cost basis or receiving a credit of 90 cents.
Right. Now, in order to receive that credit of 90 cents, you know what I've done? I've actually not lowered, but I've raised my insurance level. So I've been paid 90 cents. Go ahead, say.
Yeah, you did raise your insurance level, but you also shortened the time. That's a slight trade-off.
That's right. One of the things I like to say is don't pick stocks, pick stops. Right? But another thing I like to say is don't time trades. Trade time. This is a spread trade that's being done for a credit and has no risk. You see, there's no risk at all. I'm closing one put option, opening another, and selling one, buying another, receiving a credit. But if the stock goes up or down, it doesn't matter. I'm going to make money. I just can't hold the stock for as long as I had been holding. Right? All right. So remember, the cost basis of my stock plus put option was reduced from $30.85 down to $30.15. Now I'm receiving a credit for doing the bulletproof vest, one of the proprietary spread techniques in Blueprint. And so my new cost basis for both stock and put is $29.25. That's how much I've put up, right?
That's what you have invested in the entire setup right now, $29.25.
Right. But my new protective put is a $30 strike price. So what's my risk?
Well, what's interesting now is your risk is negative. You have a negative at risk. You're guaranteed to make at least 75 cents. If the stock stays below 30 or drops to $1 per share or drops to 5 cents per share, you're guaranteed 75 cents profit. But what else is with this position?
Well, what else goes with this is the fact that I'm holding a position that has unlimited upside potential. It still could gain more. It just can't possibly lose. So that's what we call bulletproof. We're in the bulletproof zone. All right. So what I've done is reduce the gap to less than zero. I no longer have any risk at all. All right. And let me point something out. Remember that original setup was $27.35 for the stock, $3.50 for the put. So it was $30.85 to get into it. Right.
Right.
Most folks would look at that and say, Kurt, you can't make a dime until your stock hits $30.95. Because after all, the put comes down in value as the stock goes up. Well, yes and no. It doesn't come down in value as quickly when that put is far out in time and in the money. Far out in time, it's not going to come down that fast, okay? Especially when it's in the money, okay? By the time the stock, everything that I've shown here, the stock was trading at $28.50 when I put on income method number 5. And it was at $29.40 when I closed income method number 5 at a credit, and used income method number 3 to bulletproof it. The stock was at $29.40 by that time. Now, Mike, is that lower than $30.95?
Well, it's still $1.45 below it, isn't it, Kurt?
Yeah, $1.55. Yeah, it's nowhere near where they say the break-even is. Well, see, the break-even is something that's adjustable. It's something that I can mess with.
Well, okay. The true break-even, Kurt, is only at expiration, which is 7-8 months down the road.
Right. Yes. See, that's the thing. Is this 30.85, right? That is the break-even. That's the break-even at expiration. That's not, if it's September and I'm buying in, I don't suffer that break-even deal until March of next year. All right, so folks will look at this and say, wow, you can't make any money until the stock's at $30.95. And I want to say, oh, really? Here I am with the stock at $29.40, and it's bulletproof. Now, here's the end of the story. The end of the story was, first of all, I was guaranteed to make 75 cents, but earnings did come out on November 4th, and it excited the institutional investors. Stock went up, okay, and I ended up selling for $3.85 a share profit,
Right.
not 75 cents a share. Okay, so it's nice to leave the upside open. That is cutting your losers short, letting your winners run. Right? Here's the summary. All right, never had more than just about 6% at risk. By doing income method number 5, I collected 133% more premium than a covered call trade would provide on the same day. By doing income method number 3, I made myself invincible and did it before an earnings announcement. That earnings announcement might have deleted my returns, but not after the bulletproof vest. Okay, and did it all when the stock was at $29.40. Now the stock did go up to $33.10, so I cashed it in, and I made 12%. And I know what a lot of folks say, well, Kurt, you know, isn't there commissions to all these spread trades and so forth? Well, yeah, factoring those in, it reduced my return by 1/10%. Okay.
And this was a question that Steve asked. He said, I'm concerned that commissions will eat up the potential profits in these income methods. And I told him that you were going to review this, you know, you were going to show this and how it affected it. And personally, sometimes I trade smaller positions than Kurt. I'll trade maybe 200 shares of stock or 300 shares of stock. Sometimes I'll even only trade 100 because I'm dealing with a smaller account personally than Kurt is. And if I'm only trading 100 shares of stock and one put option, naturally I see more effect on the commissions. But on average, I don't see my personal effect, the effect of commissions, lower my return by more than 0.5% or increase my losses by more than 0.5% if I decide to close the position for a small 1% loss. So I don't think the commissions, and honestly, we had this discussion last week, Kurt, I believe, when a customer was asking about it. If you just look at the general setup of a married put and then doing one income method against the position, it's the same commissions you'd have if you tried to trade a covered call and roll the covered call for higher gains, or sold a naked put and had to roll the put one direction or the other. And it's, of course, the same as if you did a bear call credit spread and had to adjust the bear call credit spread.
I have folks bring up the commission thing all the time. The fact is that commissions are an issue no matter what trading you're doing. Okay, so I leave the commissions out of it until afterwards when I'm illustrating. So this is a 12% return, but it actually was a 11.9% return after 6 weeks. Okay, so being bulletproof going into earnings makes for great nights of sleep, Mike. Even with commissions considered, I could not have possibly lost. Okay, and again, all I had at risk was 6%.
Yes.
What I ended up making was 12%. Okay, so when you make dimes, but you only risk nickels, you can actually be wrong more often than right and still make money. You know, in case you just missed it, folks, I just gave you the secret to success, and that is to skew your expectancy, to skew your risk versus your reward. When you lose, and you will lose, you want to keep those losers down into single digits. And when you win, you want to try and push those as high as they can go. You know, truly allow your winners to run. Okay? Now, again, this was a conservative example. Mike, you've seen RPMs of mine that have returned 30%, 40%. You had one last year that returned 59.8%.
Yes, and by the way, that 59.8% return that we showed, which is in one of the archive presentations on the silver Wheaton position, at the end, that 59.8% did include my commission costs.
Oh, so you included commission costs to come up with the 59.8%.
That's right.
Figure. Okay. So, and the best part about it was not the 59.8% return. The best part about it was for the first month, you had 7% at risk. And then by the end of that month, by the end of 30 days, you had no risk left at all. You were bulletproof.
Right. The first month, the first income method I did, bulletproof the position, and then I just used income method number 4, which was not shown today, to just continually move with the stock.
Very good. All right. Well, hey, Mike, let's look at the benefits here of trading radioactively. All right. First of all, it's an overlay onto whatever trading you already do. I'm not going to teach you how to pick stocks. You know, whatever you are already doing, whatever stocks you're already doing. Mike, you pick different stocks than I do.
I have to, actually, because of my my trading size. You like to use, sometimes you go into stocks that are around the $60 per share, $70 per share, and those are actually too expensive for me.
Right. So whatever stocks you're already trading, you can overlay this money management principle on top of it, okay? So that's one. Your losses are controlled from the beginning. You can't get hurt, or you can't get hurt too badly, okay, from the beginning. Bulletproofing is a real cool thing. There's several different ways to bulletproof a stock. Yeah, I mean, is that kind of fun? I mean, to be holding onto a stock that can actually do for you, but can't do a thing no matter what?
Yeah, and I mean, one of my favorite stories is I was on a coaching session with a Power Options customer who had gone to one of your presentations last year on May 6th, 2010 at about 2:45 in the afternoon. And as I'm on the phone with the customer, as I'm on the phone with the customer, he says, "Oh, wait, I got to go. Something's happening in the market. I have to go make trades." And I said, "Oh, what's happening?" And he says, "Well, it looks like, I don't know, the indexes are just collapsing. Don't you have to go and adjust your trades?" And I thought, no, 3 of 4 of my RPMs right now are bulletproof, and one of them only has a 1% risk. So if this is for real, I'm not concerned, and if it comes back up, I don't need to scramble to make any adjustments. I can take advantage of the downturn or the resulting upturn later on and still get those other positions bulletproof as well.
Right. I mean, with 75% of your positions bulletproof, right, and one of them with only 1% risk.
It's about 1.5, I think, at the time.
Yeah. It's like, yeah, so what? I actually napped, and somebody got angry with me. I told them that you know, this is a friend of mine that's in the market, right? And he told me, geez, you know, crazy day yesterday. I said, yeah, I took a nap. He got angry with me. He got angry with me that I was napping during the flash crash. But that was the truth. You know, I didn't care. So anyway, scalable. This is scalable. See, the example that I showed, Mike, used 100 shares and one put option, and that would be available to anybody with $3,000 of capital, right? But in fact, I was trading a 6-figure account and put this into 500 shares. I got 500 shares of Altera and 5 put options, and that 6% risk to that particular stock actually represented less than 1% risk to my overall portfolio that I was managing. So you know, that's it's scalable. Okay, there's bigger fish than I that would like to know that, hey, you know, you don't have to just buy 100 shares for this to work. Okay, so let me go ahead and I'm going to run one more poll here, Mike, our final poll, and just ask what things do you like most about what you saw here today? Okay, do you like the idea of starting out with very, very low risk in case you're wrong? Do you like the opportunity to adjust your risk and take income at the same time? How do you like Altera being bulletproof but still being in position to take advantage of further gains? You know? Do you like the idea of spread trades that don't introduce risk to the position but do take income? Or how do you like the prospect, the idea that there are 10 total different income methods that we use for different markets? Okay. You got 100% like bulletproof. Out of the people that have answered the poll, everybody liked the bulletproof idea. Okay. Let me go ahead and close that poll and share the results. There's pretty some more voters came in and it took it down to 9 out of 10 traders, okay, instead of 100%. But still, a lot of folks like the idea of being bulletproof. So, let me go ahead and hide that poll. Reduction to the ridiculous, okay? We're going to talk about the cost of the blueprint. Is that okay, Mike? If we were doing covered calls, okay, I could have gotten a premium of 85 cents minus 55 cents for selling the covered calls and then buying back calls, right? So that would be 30-cent premium. And since it was 5 contracts, $150 capture premium. But in fact, I got 70 cents. Okay, so that was 70 cents total premium, and I get to keep the stock. So right here, the $350, that's how much the blueprint costs.
Right.
That's just one trade. How much did you spend for the covered call course? You know, folks that are on the line that are doing covered calls, how much did they charge you for a weekend? Was it more than $350? All right, just for knowing income method number 5, that's $200 more. All right, let's look at the 90-cent credit that I took in to make my stock bulletproof. With 5 contracts, that's $450 more. $450 more.
Mm-hmm.
Knowing that technique and draw it in. Okay, so the 200 plus the 650. I'm sorry, plus the 450 is what? 650.
Mm-hmm. 650.
Yeah, and the end result in this one trade after the stock went up was $1,840. Okay, could you do this more than once?
Of course, of course.
Would it be a good idea? Would it be a good idea to, you know, if you know these techniques, use them more than one time? You know? All right, so Mike, I'm just going to urge everybody to pick up the blueprint now if they haven't, or to round out their CD collection if they haven't, and that does come with a 100% guarantee. Yes.
30-day money-back guarantee, and to be honest, ladies and gentlemen, we're not real strict about that. If you purchase the blueprint and you feel that maybe it's not for you, if you send it back in 40 days, you know, we'll still honor the guarantee, of course.
Right. Yeah, very few folks do return it, but we have had a couple of folks say, hey, you know, honestly, this isn't something that I'm going to probably do.
We even had one guy. We even had one gentleman. I thought it was fairly interesting. He did return the blueprint. This was one of the few ones we got back, and he returned it, and he said, you know, I really like what you're doing, and I'm just not getting into the market right now. I don't think I have enough saved to start trading. I'm just learning. And he returned it, but he returned it with the promise that he's probably going to buy it again 9 months from now. So,
how about that? He just wanted to have the capital now, huh?
Mm-hmm.
How about that? Very good. Okay, Mike, I've been throwing up a couple of testimonials, just some random stuff. And were there any questions that you think would be really instructive to the whole audience?
Well, here's one. Here's one. It's a little bit advanced. It's ooh, someone said thanks to me there. There you go. Oh, sorry. James wanted to know is, you know, how do you make money in the down market? Obviously, this is a bullish strategy. That basic setup is a bullish strategy. Well, James, let me just say 2 things first. Number one, yes, the basic setup is a bullish strategy. Now, the 10 different income methods, some are used if the stock's moving up, some are used if the stock is stagnating, and some can be used if the stock is falling. But if you feel that you're in a general market, it is discussed in the blueprint. Kurt has a discussion in the blueprint of a way that he feels is a better approach to using the radioactive techniques in a bearish market as opposed to just doing the married call, as opposed to just shorting stock and buying a call. He discusses another technique there. And the technique that I like to use, or I look at personally, is exactly what James mentioned, is that I'll keep the same married put setup and the same married put ideas, but on inverse ETFs.
That's right, yeah. The idea that's contained in the blueprint on how to trade this in a bear market is not what you expect. It's not shorting stock and buying a call. Requires a lot less margin to do it. And so that those ideas are contained in the blueprint. It's beyond the scope of what we could share today.
Of course.
But it's certainly doable. And of course, Mike, what you mentioned is hey, just use all the radioactive trading techniques on an inverse ETF. There you go. Now you wouldn't have to change a thing, would you?
That's right. That's right. You don't have to change your thought process. You don't have to reverse anything. As the market's falling, your RPM is moving up. You can apply the 10 different income methods just as you normally would on a married put. I hate having to reverse my thought process.
Yeah, it's like thinking upside down when you start to short things. And, it's something else. So, okay, cool. Mike, any other questions? You know, folks, you know what's going to happen? Somebody's going to think of a question right after we hang out. And so in order to have that answered, I've already flashed this up on the screen. If you have a question regarding the Power Options software, or how to find or how to manage these kinds of trades, and call this number. This is Power Financial Group. Okay, within the United States, it's 877-992-7971. Or outside the United States, +1 country code 302-992-7971. All right. If you have questions regarding radioactive trading and techniques and things about the blueprint and so forth, support at radioactivetrain.com. And if you already own the blueprint and Kurt, I'm on chapter 6 and I just don't get it, can you help me understand how this introduces zero risk? Well, go ahead and send me your questions at support at radioactivetrain.com. I'd be happy to answer them. And there's free, unlimited lifetime support that comes along with your purchase of the book.
Mm-hmm.
Okay. So, Mike, I guess I'm going to call it.
I think we're good, sir.
Pose your questions, yeah? So,
no.
Thanks for coming, and I will see you again, I think.